Welcome to the Deep Dive, where we cut through the noise and get straight to the most important insights from a stack of sources. Today, we're tackling something that, keeps every business owner up at night. Cash flow. It's truly the lifeblood of a company, dictating everything from whether you can pay your team to investing in growth. But what happens when your customers aren't paying on time and that crucial cash gets stuck, out there?
Right.
We've pulled together some excellent research that explores alternative strategies to speed up cash collection. Our mission for you today is to unpack two powerful methods companies use to get cash in hand faster, weigh their pros and cons, and walk through how you can evaluate if they're the right fit for your unique situation.
Exactly. You've hit on a core challenge. Managing receivables that's simply the money owed to your company is absolutely vital for survival.
Vital, yeah.
Even the most robust internal collection systems, sometimes they just aren't enough. Our sources dive deep into two primary ways companies accelerate cash inflow. And they offer not just the theory, but also practical step-by-step examples of how to assess, the financial viability.
Okay.
What's truly fascinating is that while the underlying goal is incredibly simple, get paid faster, the strategies themselves and their, let's say, broader implications can be surprisingly complex, nuanced even.
Okay, so let's kick things off by putting ourselves in the shoes of a business owner. Imagine you're seeing strong sales, but your bank balance feels perpetually squeezed because you're constantly waiting on invoices to be paid. That feeling of being cash poor even though you're making money.
A common problem.
What's the first lever you might pull?
Yeah.
Our sources suggest one immediate option, early settlement discounts. It sounds straightforward, doesn't it? Offer a discount for paying early. But what exactly does this entail? And actually, when we talk about something like, say, 42 receivable days, what does that actually mean for a company?
That's a great setup. An early settlement discount is precisely what it sounds like. A company offers a small percentage discount, often, 1% or maybe 2% to customers who pay their invoice within a specific shorter time frame, maybe 10 or 14 days instead of the usual 30 or 60. It essentially gives your customer a choice in payment terms.
That's choice, right?
And to your point about receivable days, that's simply the average number of days it takes your company to collect payment from its customers.
Okay.
So 42 receivable days means, on average, your cash is tied up for 42 days after you make a sale. That's a long time.
Got it. So it's about freeing up that tied up cash faster.
Yeah.
Beyond the obvious benefit of getting money in the door sooner, what's a less obvious but significant advantage that companies often overlook with these discounts?
Well, beyond the immediate cash injection, encouraging early payment naturally reduces your overall exposure to bad debts. The sooner you collect, the less likely an invoice is to become, uncollectible. And what's often overlooked, and what our sources highlight, is that for some businesses, this choice can actually enhance customer satisfaction.
Really? How so?
It empowers your customers, gives them some agency over their payment schedule, and, some really appreciate the opportunity to save a little bit of money. Feels like a small win for them.
That's a good point about customer satisfaction. I hadn't really thought of it that way. But here's where it gets really interesting. Our sources also point out some significant pitfalls. What are the key problems, the headaches, a company needs to watch out for?
Yeah, this really raises an important strategic question. First, setting the right discount terms is surprisingly tricky.
Tricky how?
If the discount is too generous, it eats into your margins. It becomes quite costly. But if it's too small, customers just won't bother taking it, right? And you've gained nothing.
Okay.
Second, it undeniably adds complexity and cost to managing your sales ledger. Suddenly, you have multiple payment streams, different dates, and budgeting receipts becomes harder because you can't be sure who will take the discount and when. It adds uncertainty. The final, and very often the biggest, headache is customer abuse.
Abuse? Like how?
You might find customers taking the discount without actually paying early, or maybe stretching that early period by a few days.
Oh, wait.
Then you face this unappealing choice. Do you spend valuable time and effort chasing a small discrepancy, potentially straining a customer relationship over a small amount? Or do you just write it off and, in effect, encourage more of that behavior? It's a tricky tightrope to walk.
That customer abuse point is a real gut check. Okay, so what does this all mean for a real company trying to make this decision? Our sources give us a fantastic example with Melvin Co. They currently have $810,000 in credit sales and those 42 receivable days we just talked about.
Right.
They're thinking of offering a 1% discount if customers pay within 14 days. But interestingly, they're also extending their standard credit terms to 50 days. That's quite a jump.
Mm-hmm.
They anticipate 40% of customers will take the discount, their credit sales might rise by 10%, presumably because of the more flexible terms overall, and admin costs will increase by $10,000 annually. How would a company like Melvin Co. even start to evaluate this?
Well, the core of the evaluation is a careful comparison. You look at the annual financial benefits versus the annual costs. Pretty standard stuff, but the details matter.
Okay.
For Melvin Co., a key benefit is the contribution earned on that expected 10% increase in credit sales. Now, when we say contribution earned, we're essentially talking about the direct profit generated from those new sales before overheads.
Got it. The extra profit.
Exactly. So on an $81,000 increase in sales, that's $24,300 in direct value for Melvin Co. That's significant.
Okay.
There's also a finance saving on reduced receivables because their overdraft, the amount they're borrowing, will presumably be lower.
Right. Less borrowing cost.
On the cost side, you have the additional $10,000 in administration. That's straightforward. And then, of course, the direct cost of the discount itself. For Melvin Co., based on their revised credit sales of $891,000, with 40% of customers taking a 1% discount. Let's see. That amounts to $3,564.
Okay, so you've got the extra profit, some finance savings, but also admin costs and the discount cost itself. When you put all those numbers together for Melvin Co., what's the final verdict? Does it make sense financially?
The analysis shows a net benefit of $11,240. So on paper, it looks positive.
$11,000. Okay.
But what's particularly insightful here is that the finance saving from reduced receivables was relatively small, only $504.
Oh, really? Why so little? I thought that was a big driver.
Well, think about it. While some customers pay faster because of the discount, others actually pay slower because the standard terms were extended to 50 days.
Oh, okay, that makes sense. The extension counteracts the speed up.
Exactly. And the overall credit sales amount also increased, which increases the total receivables base. So it cancels out some of the benefit. This specific example really highlights that cash flow isn't just about speeding things up for everyone, it's a delicate balance.
Yeah.
Sometimes what you gain on one side, you might inadvertently give up on another. Even if a calculated net benefit exists, like this $11,240, companies absolutely must consider those other qualitative factors we discussed.
The customer abuse potential?
Right, or the potential for improved satisfaction. Things that aren't easily put into dollars and cents in the model, those could easily outweigh that $11K benefit or reinforce it.
So early settlement discounts offer one way to accelerate cash, but they come with, let's say, their own set of internal challenges. Requires a delicate balancing act.
Definitely.
What if a company needs something different? Maybe offload the entire burden of receivables management and gain a more predictable, often faster cash injection. That's where factoring comes in, right?
Precisely.
What exactly is a factoring company and what service do they provide? It sounds a bit more involved.
It is, yeah. If we connect this to the bigger picture, factoring is essentially outsourcing the administration and collection of your receivables.
Outsourcing the whole thing.
Right. A factoring company steps in, takes over your entire sales ledger function. They use their significant expertise and resources. They charge a fee, of course, usually a percentage of your credit sales, but it's often more than just collection. Factors also frequently offer protection against bad debts.
Like insurance.
Sort of, yeah. And they can even lend you money, often up to, say, 80% against your outstanding receivables. This provides immediate liquidity against those future payments, gets cash in your hand now.
Okay, so it sounds like there are different levels of this protection, almost like an insurance policy, right?
Yeah.
I've heard about non-recourse and with recourse factoring. What's the fundamental difference there for a business owner trying to understand this?
That's a really crucial distinction. A non-recourse agreement is, well, it's the full service package. The factor protects your company against all bad debts related to the invoices they've bought.
All bad debts. Wow.
Yeah. If an approved customer doesn't pay, it's the factor's loss, not yours. Now, naturally, they charge a higher fee for taking on that risk.
Makes sense.
And they'll typically do their own credit checks on your customers first to manage that risk. With a recourse agreement, it's different. The factor provides no bad debt protection.
Yeah.
Your company is still on the hook if customers default. The factor is essentially just handling the collection process and maybe providing finance against the receivables. But the ultimate risk stays with you.
Got it. So non-recourse is protection. Recourse is more like admin help and maybe financing.
That's a good way to put it.
What are the big benefits of using a factor then, especially for a company that's growing rapidly? I imagine a lot of entrepreneurs feel that pinch trying to manage growth alongside collections. It must be tough.
Oh, absolutely. For a quickly growing company, factoring can be incredibly useful. Think of it like this. Your business is growing like a rocket ship. You're signing big new clients, hiring more staff, buying more inventory.
Right, all good things.
But the cash to fund all that growth isn't coming in fast enough because your new bigger invoices are still sitting out there for 30, 60, maybe 90 days. You're effectively growing so quickly that you run out of fuel, even though you're headed for the stars. That's what we call overtrading.
Overtrading, okay.
Factoring can be that critical refueling station. Management can focus on core business issues like sales, product development, operations, without worrying about scaling up their internal sales ledger function, hiring collectors, managing all that.
Kicks that off their plate.
Completely.
Yeah.
And crucially, as the business grows, the amount the factor is willing to lend usually grows automatically with your sales volume. So it provides a flexible and expanding source of finance right when you need it most.
That certainly sounds appealing, especially for a growth-focused company. But, there are always two sides. What about the counter-arguments we sometimes hear? Like that using a factor can be seen as a sign of financial weakness or that they might alienate your customers. What are the main criticisms or potential downsides?
You've hit on some common concerns, absolutely. First, the factor's charges can indeed be high. It impacts your margins, no question.
Yeah, it costs money.
Second, once a company starts using a factor, it can actually be quite difficult to rebuild its own in-house sales ledger function later on. You become reliant. It's a commitment.
Lock in.
A bit, yeah. And a significant concern for many is that factors tend to collect receivables very vigorously. After all, it's their money on the line now, or the money they've advanced.
Okay.
And that intense approach could potentially damage your company's, delicate relationship with its clients. If they feel harassed, they might blame you.
Yeah, that's a big risk.
Finally, there's that perception issue you mentioned. Historically, maybe, using a factor sometimes indicated cash flow problems. However, I'd argue this criticism is becoming less relevant. In the modern business environment, outsourcing specialized support functions, HR, IT, finance tasks, has become incredibly common and widely accepted. It's often seen as smart management now, not weakness.
That's a fair point. The context has changed. Okay, let's apply this to another real-world scenario. Velman Co. They have $700,000 in annual turnover, 48 receivable days, and a 3% bad debt rate, which seems quite high.
It is, yeah, 3% is significant.
They're considering a factor that would charge 4% of their turnover for a non-recourse agreement, so protection included.
Right, non-recourse, important detail.
This factor would reduce their receivable days to a much healthier 34 days and, crucially, cut their bad debts down to effectively zero for the factored invoices, though the source assumes an underlying 2% rate the factor manages. The factor would lend them 75% of their receivables, at 1% above Velman's current 8% overdraft rate, so 9% interest on the advance. And Velman anticipates saving $6,000 annually in administrative costs. How does this stack up financially for Velman Co.?
Okay, let's break it down for Velman. The quantifiable benefits include first, a finance saving on reduced receivables. That calculates out to $1,659. Not huge, but it's there.
Okay, $1,659.
Then you have those administration savings of $6,000. That's clear.
Yep.
But the critical and often largest benefit in a non-recourse agreement is the bad debt saved, since the factor bears the entire burden of bad debts on those approved invoices.
They save the full 3%.
Well, the source suggests the underlying rate becomes 2% with the factor's management, but effectively, Velman avoids their current 3% loss. So Velman Co. essentially saves $21,000. That's 3% of their $700,000 turnover that they won't lose anymore.
$21,000, that's substantial.
It is. Now, the primary cost is the factor's fee. That's $28,000, calculated as 4% of their $700,000 turnover.
Okay, $28,000 fee versus the savings. And the bottom line for Velman Co. Does factoring offer a clear financial win here?
Well, when you add up the benefits, $1,659 finance saving plus $6,000 admin saving plus $21,000 bad debt saving, that's $28,659. The cost is $28,000. So the net financial benefit calculated for Velman Co. is a relatively small $659.
$659, that's tiny.
It is tiny. Now, this small number isn't necessarily a definitive no, but it certainly underscores the importance of carefully scrutinizing all the estimates used in the evaluation. Are those savings figures accurate? Is the fee correct?
Right, small errors could flip the result.
Exactly. And what really stands out to me here is that this small margin forces Velman Co., and by extension, you, the listener, to give really serious consideration to those powerful qualitative factors, the things not in the spreadsheet.
Like management focus.
Precisely. What's the true value of management being able to focus entirely on growth, not chasing invoices? Or on the flip side, what's the potential cost or risk to long-standing client relationships if the factor is too aggressive in collections? These non-financial elements can often swing the decision much more significantly than a slight net benefit of, $659. It makes the qualitative assessment paramount.
What a deep dive into two distinct, yet, as you say, equally powerful approaches to speeding up cash flow. We've seen that both early settlement discounts and factoring offer legitimate ways to improve liquidity, but gosh, each comes with its own unique set of trade-offs. From the administrative burdens and potential customer relationship impacts with discounts to the significant costs and maybe vigorous collection methods of factoring, it's clear it's not just about the raw numbers. You have to understand the full, intricate picture.
Absolutely. The common thread woven through both of these strategies is the absolute necessity for a structured approach to evaluation. You simply must weigh both the quantifiable benefits and costs
The numbers.
alongside those less tangible but equally important advantages and disadvantages. These aren't just minor financial tweaks, they're pivotal decisions. They deeply impact a company's financial health and its long-term strategic direction.
So here's a final provocative thought for you listening. When you're managing any project, maybe even just your own personal budget, what hidden costs or perhaps often overlooked benefits might you be missing? And how could a structured, comprehensive approach like the one we've explored today help you uncover them, making sure you make the best decision, not just the easiest one?
That's a great takeaway. And perhaps another question for reflection. Given how increasingly common outsourcing has become across all business functions in the modern world, how might the perception of specialized financial services like factoring continue to evolve? And what new, maybe innovative financial solutions might emerge or gain wider acceptance as a result of this trend? Things we haven't even discussed today.
Lots to think about. We truly hope this deep dive has given you a clearer understanding of these critical financial tools and, maybe more importantly, the rigorous thinking behind using them effectively. Until next time, keep that cash flowing and keep learning.